Hello everyone, this is Matthew Frailey with BreakpointTrades.com. As it states here, we are master technical traders. We've been doing this since 2003, bringing advanced technical analysis, market commentary, trade ideas, and mechanical systems like you see here since 2003 for individual traders and professional institutions, some of which I consult with on a weekly basis. I hope everyone has had a nice weekend so far. Certainly been a crazy year for not just the market, but political as well, geopolitical, Ukraine, Russia. Anyway, let's go ahead and get started here. So I'm recording my weekend newsletter here. It's Sunday, March 13th. It's late afternoon. Market futures should open here in about 30 minutes. We'll see where they open. But this is my back end, so I'm going to go ahead and start this recording. So again, hope everyone's had a nice weekend so far. And if you're new to our newsletters or on YouTube, these weekend newsletters especially tend to be quite comprehensive. You know, this isn't meant to be a 5-minute, 8-minute YouTube video to quickly grab your attention or to keep those, you know, who have short attention spans around. This is meant for people who are into this stuff. They care about the markets. They want to learn. And we try to ship. That's what these are for. Okay. So anyway, this is our newsletter. It's divided into 5 major sections. I'm going to make some comments about the market here, but right after that, I'm going to talk about some administration things, some of our systems, and this upcoming trend combo system that I'm pretty excited about, which I've shared details. But after that, we'll get into the general market. We'll look at the major indexes in depth. We'll move on to indicators, bonds, look at the major sectors, and glance at a few individual stocks. I'm not offering a bunch of trade ideas simply because of the market volatility. Okay. But as far as the market here, again, you know, there's been a lot of news driving this market lately. Volatility is extreme. But having said that, our preferred scenario is it's still this leading diagonal that would have us make one more new low in the S&P and triple Qs, kind of like you see here on this image. Again, I'll discuss this below in much greater detail, but you know, instead of you having to wait for that, I wanted to show you. This is still our preferred scenario where we get this one more move down. There's an open gap still down here on the S&P, right around the 40-20 area. That could be a potential magnet. So we're looking for that to be tested possibly this week. That's our preferred scenario. Obviously, the market's very fluid. You know, if they were to have a real resolution over in the Ukraine-Russia situation, you know, obviously the market would like that. Currently, there was some mention of that this weekend. Weekend futures are actually pointing to an open or positive value, but we've seen that. We've seen a few times, a few instances of that over the last few weeks, as you know, quickly fade. So I'm not sure I'd put too much into that right now. It's also possible the market has a low in place. Our problems with that is that really it does seem like the market's in this leading diagonal. There's been a lot of overlap. And there really hasn't been this fear spike in the market. The VIX isn't spiking. In fact, the VIX was barely up on Friday. So we would like to see one more decline, wash out, get the fear in there. Then I think we have a decent trade low. Remember this week, you know, besides anything in the Ukraine-Russia situation, we have the important FOMC on Wednesday. We have OPEX on Friday. That's options expiration. And I think we have PPI this week too. So a lot of potential things to move the markets. As far as the markets, we think we're in a bear market. We've had an initial decline to the bear market. We think once we put in a decent low here, it'll be in an intermediate low. And, you know, let's say the S&P goes down to this target area. I'm then looking for maybe a move up over a month or two to form another lower high. I'm looking to ride that long. And then I think during that time, commodities will also go through a consolidation period. But remember, commodities are in a bull market. Commodities have had a fantastic year, and I hope you guys have participated in that. But I think when the market puts in a trade low here in the short term, I think those commodities will be due for a consolidation. But once then the market puts in that lower high rally, say maybe a couple months from now, commodities I think will be ready to rock again because they are in a secular bull market. Remember, I've been bullish on commodities since early last year, and I talked about it again earlier this year. Okay? So again, all my comments here, or my plans, are all laid out here in text. All right. We'll get back to the general market in a minute, but let's go ahead and move on to some of these administration things regarding the systems. So this first image here, this is an image of the SPY reversion to mean systems. It's a collection of 21 individual systems. There's 11, I think, that do longs. There's 9 that do shorts. And right now, all the systems are currently flat. What these systems do is they look for trade opportunities. They get in and they get out. They're not trend holding, trend following systems. And they do better in volatility. Okay, because we're likely in some sort of bear market, these systems should do fairly well this year. These systems do better on volatility, on sideways chop, and in bear market conditions. Right now, they're flat, but if you're at Breakpoint Trades, you're thinking about subscribing, these systems should do very well this year, given a volatility that I expect us to have. All right. Next. Image number 3. This shows you our ES systems. So what I've started doing for the website, I used to only share the trade signals for the SPY ETF. I now also share them for ES. Why do I do both? Even though they're very obviously these instruments are correlated 99%. You know, they're around the same thing, the S&P derivatives. This is the ES futures, SPY is the S&P ETF. The reason why I share both is because, you know, even they don't give exactly the same trades. Sometimes the SPY ES systems will catch better trades, better exits than the SPY, and sometimes the SPY will catch better trades than ES. And so when you do them both, you get this amalgamation. You know, they average out each other better. All right, so that's what I started doing this year, is sharing trade signals to both of these. I tell you when to enter, I tell you when to exit. All right. Next. Image number 4. Here's an example of one of our KISS trend systems. So the reversion to mean systems I just showed you above are just what I said, reversion to mean. They look to, you know, their reversion to mean. They buy pullbacks and uptrends, short rallies and downtrends. They're not trying to hold the markets for long periods of time. In fact, they're in cash most of the time. They look for statistical opportunities to get in the market, get in, get out. It's kind of like a tiger. He sits there and waits in the weeds, waits for his opportunity to pounce, you know, and that's it. So the trend following KISS systems, like you see here, they will stay in markets in uptrending conditions. By the way, these don't try to short. They're just trying to be in an uptrend. So the KISS trend system here, which I have SSO, I'm showing the example of, that's the 2-time leveraged ETF. Its goal is to be long the S&P during uptrending periods. All right. So the idea is that it'll capture the gains in a bull market, and hopefully more than the market. It'll do a little bit better than the general market, but it will capture the bull market gains, and it will be out during bear markets. And then the reversion to mean systems, which I just showed you, will do trades in between and when this is in cash. So the perfect marriage is to do both type of systems, because you're covering both bases. You have a trend following and a reversion to mean system. So you can see the KISS trend, you know, it's in cash. And if we are in a bear market, guys, the KISS trend here may not do any trades, or do very, very few trades here this year or the next couple of years, depending on how long this bear market lasts. All right. So we might not see much activity for these KISS trend systems if we've, you know, just ended an 11-year bull market. Next. Item number 5 below. This shows you the statistics to how this combination holy grail type system will work. I hate using the word holy grail, but I really do like the idea of using both a KISS, a trend following, and reversion to mean. That's what it talks about here. And this model would theoretically work in all market conditions: trending uptrends, trending downtrends, bear markets, sideways chop. It should theoretically capture gains in all market conditions. So here's an example of a table shows back to 2009 just as a, I can go back further, but I'm just showing back to here. So here's the KISS trend, annual gains for those years from the model. And what I'm using here is I'm using SSO. I'm using the idea that 50% of the cash would be in SSO in order to at least capture the gains of the S&P during bull markets. And that's the, over here is the actual return of SSO using the KISS system. But, you know, I divide it by 2 here because of the 50% allocation. So you can see the returns here, very good. Down, up 85% in 2009, up 23% last year, up about 75% in 2020. No losing years here. So far this year, it's slightly down, but again, it's very early in the year. And that number is skewed because of the end of year changeover. I'm not going to explain that here. It's not really 7% from the entry. But this is the reversion to mean system trades, which there could be around 30 trades on average in a year. Here's your gains. Again, you get some of the years it has huge gains. Look at 2009 was absolutely insane. But if you add these two together, this would be your annual gains. So the KISS and reversion to mean added together this year would be up. Market S&P's down. Last year would have made about 47% versus the 27% on the S&P, or about 1.7 times. The 2020 made 130% versus 16% on the S&P, or 8-fold times. 2018, the S&P was actually down 6% for the year. The combo system here would have made 42%. Again, I'm not going to go through all these, but you can see the examples. The KISS systems do, on average, 3 trades a year. It's not very much, with the max being 5, and sometimes only 1 trade a year. Such as 2009, it was in the whole year. And some bear markets only does 1 or 2 trades. And here's a tabular view. You can see the combo system, percent gain, the year, and the S&P is in red. So this is something I'm planning to start sharing on the website. I already shared the reversion to mean, and I kind of do the KISS. It's not, I'm still working on it, but overall, looking pretty darn good. Next, image number 6. Here's something I'm going to go through a little more detail at another time, but what I put together here is a table. It's very simple. It's showing the S&P 500 yearly gain by percentage. Your years, I'm going all the way back to basically 1920. And I have some statistics here. Again, assuming we're in some sort of bear market, don't fret, guys. As long as we know it's a bear market and we follow what's hot, you know, I think commodities are going to do well here. We can do well in a bear market. Okay, bear markets, you'll have some hot sectors like commodities or other things, and you can have very sharp rallies in bear markets and, of course, sharp sell-offs. Okay, but what I want to show here, if you look at the statistics, is just the general how the market works. So here's 106 years total. So number of consecutive up years. So the biggest or the longest trend up we had in the market was in the 1980s. It was 8 consecutive up years. That's the biggest. After that, you had 5. There was 3 of those. Okay. You could see here in the early 2000s, 2003 to 2007 was 5 consecutive up years. Okay. Then you had 4 consecutive up years. There was 2 of those. 3, there was 5, which we just had. The previous 3 years were up years. Okay. So far this year is looking like it's going to be a down year. It's obviously early in the year. And then you have your consecutive down years. And if you look here, your largest consecutive down years was 4. That was in the Great Depression. But otherwise, 3 was the max. The last time we had 3 was 2000, the tech bubble crash, 2000, late 2002. And of course, in the late 30s, early 40s. But you only had 2 instances of those. The other ones were 2. There was only 2 consecutive down years. And there was, as far as 1 down year, there was 18 of them. So most bear markets end up being 1 down year. Sometimes you have 2 or 3. All right. Now, depending on what kind of bear market this will be, we're at least expecting a 1. But given the scope of things and the Fed, all this debt, all these other things I'm reading, I wouldn't be surprised if this ends up being a little longer one, like a 2 or a 3. Now, when you look at the statistics, though, after you finally then have an up year, you almost always have at least 2 up years in a row. So, number of 2 consecutive up years after 1 or more down years is 20. If you look at this, after all these down years, you almost always have at least 2 or 3 up years. Almost always 2. So that'll present an opportunity again. Not now, but once we finally do have an up year, maybe it's 2 or 3 years from now. But the point is, we can make money during bear markets and especially after. Okay. All right, let's go ahead and move back to the newsletter. Back to the general market. So item number 7 shows the index sector table, what transpired last week. And for the major indexes and the market. So you can see big down day on Friday. For the week, the major indexes were down anywhere from 2% to almost 4% for the NASDAQ 100. Tech have been leading to the downside. Market sectors, everything was down on Friday, so broad-based sell-off. For the week, though, energy still up. Oil services up almost 10%. Energy up 2.2%. Everything else down. Currencies, U.S. dollar up 0.5% for the week, almost 0.6%. The dollar's been strong through this whole process. Cryptocurrencies were up, and they continue to hold up okay. Keep an eye on these guys because they've been leading. Bitcoin and Ethereum are in these coil patterns. It's going to be interesting to watch to see which way they break. Commodities, they finally had a pullback last week. Crude oil down 5.5%. Gasoline, natural gas down. Copper down 6%. Some of the ags up. Wheat down 8%. So quite a pullback in commodities. As you know, they have been on fire, so they finally gave something back. Again, I plan to do in-depth look at commodities in my next newsletter. Precious metals still closed positive for the week, though. Remember, about a month ago, I said that precious metals looked like they were poised to join the commodity bull market, and so far they were lagging. They're starting to come on. They were up about 1% for the week. GDX up 2.4%, so it's leading. Big sell-off in the high-yield corporate and TLT. Next, chart number 8. I actually had to pause and put my mouse on the charger. You might have saw a little message down here saying my mouse was low on power. Sorry about that. Anyway, moving on to news for this week. PPI, a big one on Tuesday. Obviously, we have the FOMC. That's the big one this week. And of course, we are in OPEX, guys. All right, let's go and move to the index charts. So this image below just shows you how this year is faring so far. S&P down almost 12%. Triple Q's down 18.5%. Small caps 11.6%. Emerging markets almost 13%. Even bonds, which a lot of brokers would have their clients in there for safety, down 5.7 to 6%. That's a high yield corporate. That's 20-year bonds. The big moves this year have been commodities, and remember they're off their highs this last week. DBC commodity ETF up 25% for the year. A lot of you guys would love those gains just for a whole year. Crude oil 45%. DBA agriculture over 10%. Corn 23.5%. Wheat almost 40%. And remember, it's well off its highs. It was up more. XLE energy 38%. Palladium 46%. Highly concentrated there in Russia. Gold up 8.6%. Fairly muted considering these other moves in the commodities. Silver 12%. GDX, the gold miners, up 19.5%. Copper up 19.5%. And US dollar up 3.7%. So despite the dollar being up pretty strong this year, all these commodities. Remember, we were bullish on commodities last year. We said we're likely to see a commodity bull market, and that's what we're seeing. Early stages of a secular bull. Now, once the general market puts in a low here, which we're thinking it could occur this week if we get a capitulation, I think the commodities will go into a 1 to 2 month consolidation, and we'll see the indexes bounce. So my plan is to play the bounce in the indexes and then rebuy into the commodities after their consolidation. Next, chart number 10. Here's that ratio chart of the S&P, or the CRB to the S&P. The CRB is the commodity index. Again, as I've been showing this chart for the last couple of years. Commodities have underperformed the S&P. That's the ratio here. And then it started forming this rounded bottom, multi-year rounded bottom. And really looked like last year it really started to want to go. And that's what happened, starting to launch out of this base. You can see how the moving average ribbon has been a good guide. It started to flip positive back here, and now it's starting to expand to the upside. Those of you who may have read Stan Weinstein's Secret to Bull and Bear Markets, I think that was my first technical analysis book I read back in the 90s. He talks about these multi-year stage one bases, and that's kind of what this ratio has. So I think commodities have entered in a secular bull market, and the general market is now in a bear market for maybe 1 to 2 years, perhaps. Next. Chart 11, this is the year. This chart shows you yearly indexes. The Dow down about 9.3%, S&P 11.8%, NASDAQ 17.9%. And DBC commodities down up 25% for the year. Okay. Next. Chart 12, here's a monthly view of the major indexes. So far, we've had 3 down months in a row. We basically had, as you know, in February, March 2020, that big sell-off, and we had that vertical move up. And at the time, I said that was just unsustainable. So we talked about this late last year. It looked more like a blow off top. We started seeing signs of negative breath as early as, late summer last year, and especially in the November timeframe, December, and that has really come home to roost. So 3 big down months in a row. Currently, the S&P and Dow are now near their middle Bollinger Bands. That's an area where we could see a potential bounce, maybe a little undercut. The NASDAQ 100, of course, is below it. Next. Chart 13, here's a quarterly view of the indexes. So you can see my comments from back in November 2020. Bull markets tend to end with blow-offs. Talk about this very strong uptrend slope. It was unsustainable. And so far, you can see for the quarter, big drop. Again, not surprising. Look how strongly this move was up, right in the upper Bollinger Bands. Just from a pure logic, common sense type thing, we were due for a consolidation. That's what we're getting. By the way, the end of quarter will be here into March, and we'll take a look at what the indexes look like then. Every year I keep a tab of quarterly market statistics, which tend to be powerful, but you need to close up for the first quarter to generally have a positive year, and so far it doesn't look like we're going to do that unless we have a huge rally this week, which I doubt. I'm looking for more of a capitulation down move. Next, moving on to the individual indexes. Here's the Dow. And first off, you can see that big sell-off we had in February, March 2020. Market had the V-ish recovery, huge rally. And the Dow in particular, the momentum started waning here. You could see the divergence that was forming the last parts of 2021. These pullbacks here represent your symmetry. This last pullback was a break in symmetry from this last peak to this low, 3,800 points, clearly larger than any of these previous, so that formed a lower high and pullback. You can see, again, the divergence was forming. And overall, what I think is going to happen is we're in some sort of bear market. Once we do get a rally, form a decent bounce, form a lower high, and then down again over time. All right. And short term, a couple things to note. The 60 stochastic at the bottom, notice I have it circled near the 50% area. That tends to be an area where you may find some initial support or slightly undercut then reverse. So considering that we're looking for a low here in the short term after maybe a washout, that's just something to be aware of. Next, chart 15, here's the daily Dow. Again, downtrending just like everything else. You can see lately we've been unable to close above the 9 EMA, and we're just simply moving lower. Now let's see if we get a final flush this week. Again, we don't often cover the Dow because, it's 30 stocks. Next, let's move on to our proxy, which is the S&P 500. So this is the monthly view of the S&P 500. So each candlestick is a month. And this is the chart that concerned us as far back as last fall. So one thing we like, you see on all our charts, we have these moving average ribbons. When they get too expanded, too wide, you're due for reversal and trend. When they're tight, pinched, that's when you get your strong moves and a trend. Well, the ribbon here got wider than we've ever seen it. We had divergence. We blew through a DeMark 13. So everything's just set up here for this moving average ribbon to go through a long consolidation period. Even back here, it doesn't look like it, but this was pretty wide right here. And it took about a year for this to unwind. Okay. So the fact how wide this is, I could see this taking a year or two to work off for the moving average ribbon to, work down to more of a pinched configuration. So I think this is going to take a long time to work off. You can see so far we've had 3 down months, and it's only just started to pinch in a little bit. What I'm pointing at down here on the stochastic, it's a little bit below the 50% area. So it's an area where sometimes you get a fake out and then a move up. But again, I am looking when we do form a low to form some kind of a lower high like I show here and then a move down. You can see we're near the middle Bollinger Bands. Next. Chart 17, here's a monthly view going all the way back to, say, 2006. So we had that bear market in 2008, and we've had this essentially, 11, 12-year, 11-year bull market. Assuming this is a high of this bull market, we added fibs here. Generally, a bear market is a retracement of a previous bull market. So at minimum, around this 38% is what you'd expect during some sort of bear market. I think this is a bit light considering everything that is going on. And I wouldn't be surprised if we get to one of these other lower fibs. But this over time, I would expect at least a move down to the 38% fib and not on this initial decline. That'll be later on in a bear market. Okay. Next. Chart 18, here's a weekly chart of the S&P. Again, big move down this year. Here's a Symmetry to monitor now. The largest pullback is that early 2020. That would project down to around this 3,500 area. Again, I don't think we're going to go down here right now. What I'm expecting is some sort of low, maybe this week, maybe around this 4,000 area, maybe even undercut it a little bit, and then some sort of reversal, rally up, form a lower high over time, and then move down, and then resume the bear market. But I'm looking for a short-term low here within maybe this week. Next. Chart 19, here's a daily view of the S&P, and this is our preferred count. You can see the various wave counts in here. I'm not going to go that in-depth to it, but this is called the leading diagonal. It looks like a falling wedge to most of you guys. And so this would argue for one more move down to a new low. There's an open gap at 40.20 to 40.35, which would be a convenient target. So something like this. Then we're looking for some sort of trade low, and I think it'll present a long opportunity that will then allow the market to have, a move up maybe to May, June timeframe, but ultimately form a lower high in a bear market. Okay. So that's what I'm watching here short term. So now the market, is it possible we could have a low? It is, but it would need to show itself, need to at least get over this downtrend line and 20-day moving average on a closing basis. Next. Chart 20, here's another daily chart of the S&P. Shows the same thing, just zoomed out a little bit. And what we're targeting is this open gap, which is from April 2020 at 40.20 to 40.34. The S&P likes to fill these open gaps, and that would be a convenient area just to fill that since it's not honestly too far away. In this market, when you can have these 100-point moves, you can get there in a couple days. So ideally going to move down into here, maybe even undercut it, and then form some sort of decent trade low that would hold for, 2 or 3 months maybe. Then ultimately, though, would form a lower high bear market rally. That would give a chance for commodities to consolidate and then give you an opportunity to buy the commodities at a later date for another big run. Next, chart 22. Here's a 2-hour chart, the one I've been showing for the last couple weeks. And this has played out so far pretty beautifully. So we've had these 4 waves in this kind of wedge pattern. Our argues for one more move down. Note that the 4100 area could be like a double bottom, okay? But undercutting that, then I would be targeting that open gap below, okay? Moving average ribbon here, you can see is a good guide. It gets too wide, expanded. That was all the trade lows here. But now it's not expanded. It's more pinching from the underside, okay? Next, chart 22. Here's a 60-minute chart. So see the moving average ribbon here, and shows you the same thing. Here I got a little dotted lower trend line. If that breaks, then likely that'll start to move down to this lower portion. The trend line in red here, that's the trend line from the January highs. And yes, the price here overshoots, but that's fine. Price has been respecting that. So for the bulls, you'd at least, if we were to regain and get above this, then I think it's possible we have the lows in. But like I said, like Missouri, the show me state, which is right next to Illinois where I live, it's got to show me. And so far it hasn't. So far the trend is down and it looks weak. Next, chart 23, here's another 60-minute chart. So again, we simply had an ABC bounce moving lower, and that's your next support right here in this coil-like pattern. Next, chart 24, here's the 30-minute chart. Shows you the same thing. We do have a little perfect symmetry move from this pullback to this pullback here with the see the dotted lines. So could we have a little low here and rally up? Perhaps. But again, we'll see how everything goes tonight with futures and this week. Next, chart 25, here's a 15-minute chart. It's the last Wednesday that rally stalled right here at that extended broken trend line. It was support here, broke, back tested there on March 9th, late in the day. That was a good shorting opportunity. So far, we've had a perfect symmetry move. So, could we bounce here? Yes. But, the bulls need to really take the football and rally hard, all right? And I have my doubts about that. Next, chart 26, here's the 10-minute chart. This is what we were showing early last week, and this played out beautifully. So early in the week, we were expecting a sharp rally in A, and we got it. Remember, everyone was bearish down there on March 8th. We got that rally. Then we pulled back. We expected another rally and a C, and that's exactly what we got there on that Tuesday. I'm sorry, on that Wednesday. So I know when I did the market newsletter last week on Wednesday, everyone was super bearish here. We were expecting a rally, and that's exactly what we got. So that we got that. We were looking for that to be a short opportunity, and that's exactly what happened. Then we got another lower high in here. And so, more than likely, if you've been following us, you should be short from either this day or maybe early Friday. Next, image number 27. This shows you the various cycles. Not a lot to say here on the cycles. The 120-minute here, you had resistance. Resistance cycles show up on Friday. We have the ATR resistance. And on the 60-minute, we still have potential ATR support here. We have an cycle support on 195-minute. Next. Chart 28, here's moving on to the triple Qs. This is the monthly chart. Again, 3 down months in a row. and closing below the 20-month moving average here. So a couple things to note that I'm watching. The stochastics down here, notice the 14 monthly stochastics, a little bit under 50%. During the last time, you had a little fake out there in late 2018. You didn't confirm that low. You, in fact, reversed there. And the 60 stochastic is still testing the 80% area. You see that? And the last couple times it bounced off of there. So is this an area for it to find support or break through? We'll see. But last times they did not confirm a sell there. Those were areas where you got to bounce. Next, chart 29, here's the weekly chart, down 3.8%. 38% fib there is at 314.70. Next, chart 30, here's the daily chart. So very similar to the S&P. We're watching this ending diagonal type scenario. Get a new low there, maybe form some sort of better trade low. We do have some MACD divergence for now. Next, chart 31, here's the 2-hour time frame. First off, look at your moving average ribbon. When they get too expanded, you're due for a reversal in trend, and that's what happened at the last lows. But right now, we don't have that. And you do have a little symmetry move. The last support is that lower dotted trend line connected from the lows. Next, chart number 32, here's the daily KISS. So obviously the KISS systems have been in cash, like the triple Qs. It's been in cash since the beginning of the year here. Don't expect many trades from this, assuming we're in a bear market. Next, chart number 33, here's the various cycle time frames, very similar to the S&P. Okay. Next, moving to the Russell 2000, this is the weekly chart. You can see down about 1%. And last year we had that symmetry break, lower high that formed in December, broke that big shelf support. Now, if we do form some sort of trade low, I still expect that area to be resistance. Over time, I think that IWM could work its way down to that 165 area. Next, chart number 35, here's the daily chart. We had that double bottom in February, so far a weak bounce. Again, you can see you have a downtrend line here and an uptrend line. We'll see which way this breaks. Next, chart number 35, IWM, another daily chart. This shows it as a diamond. Now, technically, this is a bullish diamond because the apex, the top one, is further to the right, but it could go either way. One thing that could occur on the markets, guys, is the S&P makes a new low, but IWM does not. Maybe it breaks down just a little bit. We'll see. We'll see which way this goes. Finally, chart number 37, here's the 2-hour time frame showing you support and resistance. We're basically right in the middle of it in this rectangle type pattern. All right, that does it for the major indexes, guys. Let's move on and look at some indicators. Chart number 38, here's the VIX. So the VIX gave a buy signal last week that did give a trade for at least a day. The next day, the market was up. And then, of course, Friday was the big down day. All right. One thing that Steve and I pointed out is that the VIX is not really responding very well with the market. You can see the VIX was barely up on Friday, basically a little doji candlestick. But Friday was a big down day. So what that says is fear is not ramping here in the market. In fact, you see the correlation starting to dip. So to see a really good trade low, what I'd want to see is the VIX spike. Next, chart number 39, here's the CPC put-call ratio, and this is only at 1.05. That's not very high, so there's not a lot of fear here. It's been more of an orderly sell-off. Next, chart number 40, here's the S&P with the Ridex bear funds, and they're starting to spike here on the weekly. You know, you tend to get these spikes near major lows. Why? Well, the masses tend to be wrong. The masses are loading into bear funds typically at lows. All right, so they're spiking here, but that doesn't mean we're bottomed yet. Like I said, I think the market could use one more down move to wash it out, and then I think we could have some decent low. But notice they are starting to spike now. Next, Chart 41, here's the NASDAQ with these breadth indicators, 52-week highs, 52-week lows, and the difference, 52-week highs minus 52-week lows. This has been a fantastic indicator. I showed this back in November, December. I said that the fact that this difference was below zero pointed to bear market territory, and it needed to go back positive, and it never has. Next. Chart 42, here's the NAHL. Plotted as a cumulative. This also started diving here in December, losing these moving averages. You can see last time in 2018 that happened. That was a good guide. It showed you that breadth was horrible on the market underneath the surface. Next, chart 43. This was given a warning way back in July and, of course, in November with the percentage of stocks above the 200-day moving average. When the NASDAQ was at new highs, the percentage of stocks above the 200-day moving average was in the low 30s. Okay. The problem with the indexes is that you have a handful of stocks like Apple, Microsoft, that represent most of the index gains. Under the surface, you were seeing a lot of damage, basically the stealth bear market, and it finally started showing itself. But this was an early warning. Next. Chart 44, here's the yield curve. We continue to monitor this. Continues to go lower every week. It's now at 1.14, the ratio. It's the 10-year divided by the 2-year. When this goes below 1, it'll be inverted, and that will ensure some sort of recession. As you know, economy has been slowing sharply, and given the commodities rise recently, that's only going to speed things up. Next. Chart 45, this is the S&P versus high-yield corporate. So the high-yield corporate and the S&P tend to move lockstep together, but high-yield corporate started lagging late last year. You can see how the slope was much less than the S&P, and this gave an early warning. By the way, this made a new low last week. The S&P has not, so that may be foretelling for the S&P to make another low. Next. Chart 46, here's HYG on the daily. So again, it did make a new low, unlike the S&P. So it has been leading. Maybe that'll pull the S&P down. But you do have a falling wedge potential I'm watching for here now. Next. Chart 47, TLT, 20-year bonds. Had a big sell-off last week, making a new low. There is some MACD divergence potential now. Next. Chart 48, TLT on the weekly. Down about 3.8%. There is a support here to monitor. Next. Chart 49, 10-year Treasury Yield on the weekly, up 16.25%, closed at 2%. Symmetry measures at least back up into this range over time, if not much higher longer term. Next. Chart 50, here's the 10-year Treasury Yield, going back to the early 70s. So interest rates have been in a long-term secular bear market. We've had a sharp rally recently, but it needs to get over this long-term downtrend line to really begin a long-term uptrend, or to confirm it. You got to use a logarithmic chart here in order to draw a well-defined downtrend line. But that's up around the 2.5%, 2.7% area, this trend line. Next. Chart 51, here's the daily 10-year Treasury Yield. Looks like it wants to make a new high. Next. Moving on to some sectors and a few commodities. Here's DBC. That's the commodity ETF. So this is comments from about a week ago. Commodities tend to end in these blow-offs. You can see this clear 5-wave uptrend move starting from 2020 when I became bullish on commodities. So I expect this to be the first leg of a major bull market, then us to have some sort of ABC decline, and then after that, another big move in the secular bull market. But what I'm thinking, guys, is that as the general market puts in some sort of trade low, maybe this week, then that'll start a decent consolidation on commodities. Next, chart 53, EEM, emerging markets, obviously been hammered. This is a weekly chart. So far retraced more than 50% of the move off the 2020 lows. Next. Chart 54, XLE Energy. It's been the big runner this year, off its highs last week, but still up 2%. You know, it broke this weekly up downtrend line way back the first week of January. That was your opportunity to buy it. Hope some of you did. Again, don't fret, guys. This should be in a long-term secular bull market, so the next good consolidation should give you another buy opportunity. Next. Chart 55, here's the daily chart. Again, I identified this bullish symmetry break way back here in late December. That was the time to go long, or on this trend line break, or on these pullbacks, which have been perfectly symmetrical. Now, short term, we do have a little symmetry break here. So these pullbacks were symmetrical in January and February. This last pullback is a little bit deeper. So maybe we'll form a lower high, then come down again. Next. Chart 56, here's the XLE S&P ratio. I showed this late last year as a bullish ascending triangle, and that obviously played out beautifully. Next. Chart 57, oil services. Very similar to look to the XLE. You have a little symmetry break short term. Again, it's XLE and OH did not break their 9 EMAs, but you do have a little symmetry break with respect to these last few pullbacks, so I'm looking for maybe a lower high here. Next. Chart 58, oil services on the weekly. Boy, I've talked about this before. Finally broke out of this big pattern. This could have a long way to go. Look how high this sucker was back in 2014, up at 1,000. Again, it could have a long way to go over time, assuming they're in a bull market now. Next. Chart 59, XME, metals and mining. They obviously have had a good year. So far, well off their highs here. Moving average ribbon is pretty wide here, so if commodities go into consolidation, I'd expect this to as well. Still holding the 9 EMA, though. Next. Chart 60, XLU utilities, another area that has benefited. Pulled back off the highs, though, recently. Still holding the 9 EMA. Next. Chart 61, ARC, Kathy Woods. Look at this Christmas tree. All the way up, all the way down. Nice coil opportunity to short last fall. Get a short of that sucker at 110 bucks. These would be my next targets to the downside. Poor Kathy Woods. Here's the thing about Kathy. I understand her arguments regarding technology. I think they're valid points. But if we go into a bear market that lasts 2 or 3 years, even if she ultimately is right, Kathy's not going to be around. She won't survive that. Okay? So anyway, when the market does put in a trade low, let's say it this week, maybe, this will likely bounce. Next. Chart 62, banks. Obviously broke this uptrend line. Has a bear flag here right now at the 9 EMA. It is sold off with the market, and that yield curve is not helping it. Next. Chart 63, banks on the weekly. You can see the symmetry break back here, lower high. Longer term target could be around this 115, 114 area. Next. Chart 64, XLF financials. Same look as banks, essentially. Bear flagging into the 9 EMA. Next. Chart 65, XBI Biotech. Now, this is an area I'm watching for a long opportunity. I drew it as a wedge last week. It may need one more move down here. If it gets that next move in a reversal, I think it's a decent swing opportunity. You got a MACD divergence here, etc. Next. Chart 66, semiconductors. Obviously downtrending with the market. You can see the symmetry break back there in December, lower high. Downtrending. These are your next target areas below. You do have some MACD divergence forming. Next. Chart 67, transports. Overall downtrending, obviously. Next. Chart 68, materials. Downtrending, stalled right at the downtrend line last week. That's your next big support down there at 78. Next. Chart 69, XLI, industrials. Stalling to the downtrend line. Then we'll see where this ends up going over time. It did get into that support zone a few weeks back. Found support there. Next. Chart 70, XLP, consumer staples. Big dump last week. Closed below its 200-day moving average now. It was holding up better than the other sectors relative, but lost its gain there. Next. Chart 71, healthcare. So far, the last two rallies stalling at Symmetry, and this one stalled at the 50-day. Well off the lows, though. Next. Chart 72, consumer discretionary. There's lower highs. Monitor Symmetry over time. It's been capping the rallies, as well as the 9 EMA short term. Next. Chart 70. Chart 74, retail. Nice downtrend here. You got a coil forming, so we'll see if we get one more bust move to the downside. You can also see your Symmetry moves. Next. Chart 75, real estate, holding up better than the general market, obviously. So we'll see where this lot goes over time. I do believe, retail or the real estate market is held up very well. It's still very hot. Inventory's low, but ultimately, guys, if we get an economic slowdown, recession, I do believe the housing will eventually fall. Next. Chart 76, home builders, been downtrending quite strongly here since that Symmetry break back here, lower high. All right, that does it for the sectors. Let's move on. Chart 77, Bitcoin, got to keep an eye on this. It's been in general bleeding. It's still holding into this pattern for now. Hasn't broken up or down. Next. Chart 78, Mara, it's one of the Bitcoin type stocks. It's more like a Christmas tree, fell from 83.5 all the way down to 19 recently. It's coiling pretty tightly. We'll see which way this one breaks. Next. Looking at some of these other stocks like Facebook here, Meta. If we're in a bear market, here's an example of what I'd expect. Eventual bounce here, but lower high, maybe into the summer, and then eventually a longer decline later in the year, maybe into 2023, something like that. Next. Chart 80, PayPal. Perfect Christmas tree. Look at that move up from 2020. Double top, 2021. Straight down. I know one of my professional investors who's held this thing the entire way down. Next. Chart 81, Roblox. Nice decline from the November highs. My kids play this all the time. Maybe a wedge. Again, when the market does put in a low here, I expect all this stuff to put some sort of oversold rally in. Next. Chart 82, Adobe. Also a big decline recently. Here's the weekly. 200-week moving average is approaching. You can see the Symmetry break that occurred last year. Next. Chart 83, there's the daily chart. So far, all the rallies capped at Symmetry. This chart still looks quite ugly. Next. Chart 84, Amazon. It bounced from that divergent low, announced a stock split. This is one to monitor over time. This is one maybe we won't see test the low again because they announced a stock split and a buyback. Notice the moving average ribbons are quite expanded now. Next. Chart 85, there's the weekly long-term view. Though over time, I do think Amazon will work lower over time in a bear market. Next. Chart 86, Apple, crapple near the 200-day moving average. Maybe we get a little undercut of that and then bounce. But again, guys, if we are in a true bear market, Apple will not be immune to it. It will go through a decent correction over time. Finally, chart 87, Zim. I mentioned this one last week. This is one interesting. Actually, I've listed this since January. It was a high dividend play, paying about $10 dividend a year, $2.50 a quarter, very low PE. But they announced recently a $17 one-time dividend with the ex-dividend on March 22nd, payable on April 4th. Okay. Again, it's not going to be a free lunch on that ex-dividend date. I expect a decline, but maybe this will rally up further into that ex-dividend date. That's quite a nice dividend. So there you go, guys. Again, we'll see how the market fares tonight on the futures and for this week. Have a wonderful evening. Take care.